Okay, recording this video is Thursday, 24th of November 2011, Thanksgiving Day in the US. So if you're American, happy Thanksgiving Day. I hope everybody's enjoying a couple of days rest from the markets. Thought I'd record a video about some FX charts. Got a whole bunch of emails kind of asking questions after I did the last video, just talking about the strength in the US dollar kind of going forward, and just wanted to respond to, in particular, this email from Mick. So Mick starts off, "Hi Barry, thanks for your last analysis of the euro. I've been wondering that myself. I was wondering if you could give feedback. The British pound, is it going the way of the euro, and also the Canadian dollar? Always enjoy your videos, your honest, down-to-earth comments. Cheers, Mick." So let's have a look at those charts. First of all, a comment. The euro was kind of holding up at the beginning of this week at about 135 versus the US dollar. This is a daily chart of the euro futures. And it seemed as if there was a little bit of strength kind of coming into the market there. Who knows whether the ECB was kind of intervening or whatever, but then on Wednesday it kind of fell through that support kind of level and is really looking pretty weak. And then today we get the news, Angela Merkel's kind of coming out and saying that no way, Jose, to euro bonds. So that's these kind of two avenues. We're gradually shutting it down avenues in the eurozone for kind of dealing with systemic risk and collapse of the sovereign bond market, blah blah blah. So one of those avenues was create euro-wide bonds, and everybody kind of throw their bonds into the pot. And when you smooth out, average out all of the kind of debt to GDP of the whole eurozone, it looks far healthier. It's not great, but it's healthier than Greece at 160 and Italy at 120 and so on and so forth. But Angela Merkel has said, as far as the Germans are concerned, no way, they're not going to do that. They're not going to be joint and severally liable for everybody else's debts. So that kind of leaves the ECB for kind of monetization. And we know what the rules are there. They're not allowed to directly monetize. I know they've been doing so kind of in the secondary market to some extent, kind of trying to keep the yields down. So it's all getting extremely interesting in Europe. And so the euro kind of topped out here at 148s. Huge rush for the door here after we had exhaustion buying at this point. And this move kind of got going with that huge selling. You can see we tested back into that 46, 48 level a couple of times with Rambo patterns up here. Rambo pattern again. So this is kind of amateurs, and this was all the discussion around July about the debt ceiling in the US, and everybody was saying, well, the US dollar is toast, blah blah blah. Well, no. It's the euro that's having the problem. As you can see, less and less buying going on here, and we've just kind of fallen through this 140 level. We came back up to test the last time. We had a couple of big blue professional bars taking profits and kind of going the other way, and this last amateur up bar we kind of corrected and have kind of gone the other way. I know we're looking at all these kind of flush signals down here, but remember, we've not seen exhaustion selling in order to get to see an end to the selling, and then we can start building divergence patterns. These are just responding to this last kind of sell down here. So my feeling is we're going to break through 132 probably next week and keep on going until we get that type of exhaustion selling. So it's interesting times kind of happening in the euro, and so that means kind of strength in the US dollar and US bonds. Now everybody kind of been wittering on about this story for 6 months now. So but just thought I'd kind of step back and take a look at kind of the pound, the loonie as well, and just look at things in a kind of big picture. And so let me show you this chart, very colorful chart, and it's going back 10-11 years to 2000. Now what I've got on here is all kind of the major currencies on the one chart expressed as relative strength versus the US dollar. And I've also got the dollar index here, which is a basket of kind of the major currencies. Last video I did on FX, I said that I thought the euro was 30 to 40% of the dollar index. It's not. It's closer to 60%. I thought I knew that, but anyway, So if anybody misled them by saying that the euro was only 30 or 40% of the dollar index, apologies. It's a lot bigger. It's closer to 60%. And then there's there's the pound, there's the yen, there's the Swiss franc, and so on, kind of involved in the dollar index. And it's kind of a trade-weighted basket of the other currencies. Anyway, let's look at this chart. So let's go back to 2000. Let's just see what was kind of going on. First of all, let's look at this in terms of the dollar index. So dollar index here is this light blue cyan line here, where we had strength. We actually had from about 92, there was strength in the US dollar coming into 2001, and that was driven by a huge amount of inward investment into the tech boom in the US, and coming out of that recession in the US in 91, 92, there was a lot of kind of economic growth and investment opportunities in the US, and so that dollar index had been extremely strong coming into that, and basically topped out after September 11th pretty much. Now at the onset of September 11th, what we actually saw was the Fed was willing to really massively go in and devalue the dollar, and print money, keep rates super low, kind of support deficit spending and so on. So all of that has been very negative in terms of the dollar, and that's why a lot of people have said that the US dollar is toast. Buy gold, buy silver, buy kind of precious metals, because in the long term the US dollar will absolutely collapse. Well, that could well be true in the long term, but we've still got to get through the medium term and the long term. So as a result of that kind of money printing starting in 2001, we had 10 years of decline into the US dollar here. Now, during the financial crisis, kind of the worst of the financial crisis during 2008, you see we had quite a big blip back up in the US dollar, and that was the flight to safety. So that was kind of buying back in when everything else seemed like a wreck, buying back into US treasuries, and that caused a jump up in the US dollar. And then subsequently we've had QE1, QE2, kind of Fed intervention and so on, and so we've seen kind of more weakness in the US dollar. But now we're at a crux here. It's like it's like a double, triple bottom type here. Mid 2011, back to this June 9th video I was going on about the other day, just saying starting to see the bottom of that US dollar. And that's where we've started to see the US dollar index kind of creep up. And so I think we're at interesting times. Now, let's look at a couple of the other currencies here, because we've got this whole kind of kaleidoscope of currencies kind of going on. And just on the verticals here, I've just marked those three kind of points. So first of all, peak in the US dollar, 2001, 2002, kind of the low of the dollar in 2008 before we had this rise, the global financial crisis, then continued money printing by the Fed into 2011, and then this kind of bottoming activity in the dollar at the moment. Now, on this chart, first let's go kind of top to bottom. So at the top here, the white line is Swiss franc. Swiss franc's been doing extremely well. So Swiss franc kind of closely associated with gold, a lot of gold kind of positions held in Swiss vaults. And as money printing kind of goes on, if you're not going to buy gold, what are you going to buy instead? You're going to buy the Swiss franc. Those are two kind of safety plays that you could play. And so, and actually the best place thing to have done over that time period was actually to buy your gold in Swiss francs. So the strength in the Swiss franc has been just extraordinary over that kind of 10-11 year period, and then we had this extraordinary move by the Swiss central bank kind of intervening because their currency just got way out of hand. And this last kind of move up in the last year and a half, I've been again one of these things I'm kind of saying, and it's become now I'm actually starting to read it in the papers. It's everybody withdrawing their money from peripheral countries in Europe and putting it in Swiss banks. So the Greeks have moved 81 billion or something like that of euros into Swiss banks over a period of time. So and that's what this strength has been, kind of buying into those Swiss francs to get some protection from the euro. And then the Swiss central bank had to intervene because it just kind of got out of hand. Then we've got here we've got in green we've got the Aussie dollar. And alongside that, in this magenta, beautiful kind of purpley colour, we have the Canadian dollar. And you can see over this time period, if you look at the green line here and the magenta line, they've been very closely associated. Now, the Aussie and the loonie are both commodity-based currencies. So you've got the Aussie kind of selling into China and the Asian markets in terms of exports, commodity exports, and then you've got the Canadian exports kind of selling into North America. and because they're kind of closely associated with commodity prices, they tend to move very closely together, and you can see we've had this kind of commodity price boom. I mean, it's had a couple of legs to it, going through the 2000s, and then got very badly hit. The Canadian and the Aussie dollar got very badly hit during the financial crisis here, and the Aussie went from I think it was about $1.10 down to 80 cents very, very quickly. And the Aussie tends to be extremely high beta kind of moves in it. That's why a lot of people like trading it, because it moves in bigger kind of step jumps, compared to a lot of the other currencies, and you can see that in the decline that we had during that financial crisis, and then recovered with kind of the growth in commodity prices and the money printing and so on, and the growth in the emerging markets over that time period. So those are the next two currencies. And then in blue we've got the euro. So dark blue here is the euro, and again, euro very similar to that, a little bit less kind of beta than the Aussie and the loonie, and what's going on there is basically the euro over that time period has been viewed as a risk-on country, so there's been quite a lot of movement into the euro, and then we've started to see that weakening over this time period. Now, a couple of standouts that kind of don't go along with this kind of pattern. The first one is in red, British pound. Now, British pound kind of topped out about 2007, 2008 here, and if you're English, you'll kind of remember the pound was about 2-to-1 to the US dollar, and we had all the English people flying over to New York and going shopping in Barney's, and that was kind of the peak of the strength in the US, in the British pound. Since then, the pound got kind of creamed during the financial crisis and has basically done nothing since. Partly that's a result of the two things. First of all, the pound, the British Central Bank has been, the Bank of England has been extremely quick to monetize, just like the Fed. They kind of got on board quantitative easing kind of straight away. And then the other reason is that the UK is kind of closely associated with kind of exports and the European economy. So if we get kind of weakness in the European economy, that'll be reflected in difficulty with the export markets for the UK. So that's why the pound has basically just been treading water here, whereas we had continued strength in these other emerging markets, commodity markets and so on, but the pound has really not been doing much of anything. But broadly speaking, in terms of the way it kind of generally moves, it does move with those other currencies. It's just been faltering for that kind of a reason. So you've got all those currencies kind of sit together, if you like, as a whole basket, and that's kind of the risk-on basket. And then you can choose the highest beta of those being something like the Aussie, and then kind of the lowest beta would be something like the pound. And then you've got in the middle, we've got the Japanese yen in yellow here, and the Japanese yen has kind of changed character. During this early period, we had the carry trade, and the US dollar and the yen at that time were the lowest, the cheapest currencies in order to borrow with. And they also had low interest rates, plus those currencies tended to be weakening, so it was a great place to kind of borrow your money and buy into the carry trade and buy into high growth economies. So because you're going to get a double whammy, you're going to get a higher yield or a higher kind of growth exposure in those growth economies, and in the meantime those currencies are going up versus the yen and the US dollar. And so that was kind of the this period here, 2002 to 2008, was kind of the real meat of that kind of carry trade. I mean, I think it's been going on for close to 20 years, but that was when these two currencies were kind of more closely aligned. Now, but since 2007, 2008, Japanese yen has actually been strengthening really quite strongly. It'll be interesting. I mean, I don't have a view. It's like I'd listen a lot to people like Hugh Hendry and so on talking about the weaknesses in the Japanese economy, and definitely they're there for everybody to see, but it's not happened yet. So it'd be interesting to see if the Japanese yen takes on this character. Was it a risk? Was it a risk-on kind of trade over the last 5 years, and it's going to reverse, or what was driving this strength in the Japanese yen? Because certainly in the last 6 months, you certainly hear the Japanese exporters really complaining about the strength in the Japanese yen, and in the last kind of series of results that we had from the major exporters out of Japan, they all had really weak earning numbers, and that was a result of the strength of the yen. So not sure what's going to happen there, but it's kind of changed character over the years between being a carry trade and close to the US dollar, and then more into a risk-on type currency over the last few years. So there we go, that's kind of big picture. Now the takeaway from that is to basically say, look at the US dollar versus everything else. The yen is kind of a little bit different, but you've basically kind of got risk on and risk off. So when you get a question from Mick about, well, what about the Canadian dollar and the British pound versus the euro? Well, they're going to look extremely similar to that. It's just a question of the amount of movement relative to the other currencies, so the beta, if you like, in those currencies, the highest being in something like the Canadian dollar, the lowest being in something like the British pound. But then let's just go through a couple of the other kind of charts just to show you those in kind of context. So these were the commitment of traders charts that I was showing the other day, and let me show you kind of the rest of them. So this is Aussie dollar weekly chart commitment of traders, and I was again just talking about the divergence patterns, and this is what I'm looking at mostly in terms of commitment of traders numbers. Nicely marked at the end of financial crisis, these little bullish divergence signals, bang, and we took off. And you can just see the weakness that we've had in the commitment of traders numbers compared to what's going on here at the Aussie dollar 105 type level up there. And not sure what it says on the monthly chart, but let me just show you that. You can just see that kind of coming off there. We had the bottom kind of marked here nicely, and these bottoms, with these divergence patterns have been really great. We didn't actually get a signal up here, but you did get one on the weekly chart. And that's why I look at the two, the monthly and the weekly chart, just because you get those kind of anomalies. British pound. Okay, so here we go. Now it's like, look at this kind of ranging activity in the British pound versus the US dollar over this 2-3 year period. It's just been kind of going nowhere. But the top of the market was marked with all these divergence patterns. We kind of fell off a cliff, and we had some strength kind of coming in with these bullish divergence patterns, and then this little family here of bearish divergence signals, and we've had weakness in the pound going forward, and this looks extremely weak here. And then let's look at that on the monthly chart. British pound, again, same thing, top of the market, these kind of strength periods, and then this last couple of months, we had these bearish divergence signals kind of go off here. So, for me, the British pound is in the same boat as everything else, as the euro and Aussie dollar and so on. It's like, it's looking just as weak as them. Then let's look at Canadian dollar on a weekly chart again. Similar pattern, bearish divergence, bullish divergence at the bottom, rallied back up, 105, Canadian dollar, bearish divergence, and look at this, just falling off a cliff. And on the Canadian dollar monthly chart, similar thing, nicely marked at the top here, tops, bottoms, tops. I mean, I quite like this commitment of traders stuff on a longer term time frame. It just kind of, it's got some nice little signals. Anyway, Swiss franc on a weekly chart, and here's this spike activity in the Swiss franc. It just went nuts with kind of the rush to safety, and the Swiss central bank just had to intervene at that point there, and there you get the bearish divergence signal, bang. So we fall off, and we've had a second one on the weekly chart a couple of weeks ago, and then go to the monthly chart, and you can just see the weakness kind of here. We had the divergence signal kind of pre that peak. And then just looking at the normal kind of day trading, I beg your pardon, the normal kind of beta indicators on these charts. So let's look Canadian dollar first of all on a monthly chart, and we had 2007, 2008. This is where we had this spike up to $1.10 Canadian dollar, and this is where the Canadians were feeling incredibly pleased with themselves, and then kind of fell off here in global financial crisis, and we've kind of come back up. Now, interestingly, we've not made the kind of we've tested back up to those peaks, but look at the exhaustion buying here into these highs. Exhaustion buying. We've just run out of steam here, and we're kind of turning the other way. When we go to weekly chart, again, we moved past an end of trend signal here, just kept on moving forward a little bit, 105, eventually just ran out of puff, flush signals up here at the highs, and we've just kind of gone, this is a rush for the doors, so this kind of selling activity is just getting this move going. We've come back up, support becomes resistance on a weekly chart, we're turning back over. And then on the daily chart, you can see that, this rolling over activity in the last month, Rambo patterns, amateur bars up here, and we've just fallen through cyclical support, so we're in a downtrend here. Aussie dollar, similar picture. Let me just show you the monthly chart here. I mean, the Australians, when we got to $1.10, they felt very pleased with themselves, and we kind of tested back up a couple of times, and all those blue professional bars, extreme exhaustion buying up there. weekly chart here. Now this, so with first move in, pullback to end of trend, then we had exhaustion selling on this move here mid last year, and we flushed out all the sellers at that point when it kind of tested back just below 80 cents and then kind of moved on. And then this last pullback to end of trend move got violated at the pullback level. This has been such a strong trend. When you see kind of multiple pullback to end of trends, the last one, if you get a couple in a row or 3 in a row, the last one rarely makes it to that kind of end of trend. We just kind of gave up the ghost here. But look at that exhaustion buying, trying to push it through, just gave up and bang, gone the other way. So in the last 3 or 4 days, or the last week or so, in the Aussie dollar, it's got hammered from the kind of 103, 104 down to the 98s, 97s, and then on the daily chart, here we go, up into these highs, end of trend, just gasping up here, Rambo patterns, flush signals, bang, and that's kind of getting this move going, all the professionals selling it, and we come back up and test each time into this kind of zone where the professionals were selling it down, and each time we just Rambo patterns at the top, amateur up bars, bang, kind of go the other way. So because this has been this kind of exhaustion selling, this is a rush for the doors, getting this thing going. This thing isn't over until we see that kind of exhaustion selling down, and we're coming down to the 95s kind of previous levels, kind of down here. They've been extremely important, and if a lot of the confidence in the market and confidence in what's happened in Europe will go, and more kind of starting to, the news stories out of China is starting to get weaker and weaker. The Aussie dollar will be affected by that. Pound monthly chart. This is the 2-to-1 kind of pound back in 2007. Pullback to end of trend up here, exhaustion buying, and then it just went slam in the global financial crisis. Kind of bottomed here after exhaustion selling, come back up. It's interesting, these kind of weak, but I mean, this is even with all of that exhaustion buying, that was as good as we were able to push it up to, just under 170. So there's a lot of people just selling that down as it was kind of coming in. So just kind of given up the ghost there, turned over on the monthly chart. On the weekly chart, you can see here, just couldn't get back up through 170, and all these flush signals, and this last little move up last couple of weeks, that was exhaustion buying, and we just went bang the other way. So we're coming up to cyclical resistance, and you can see here that was that exhaustion buying coming up into this move. A couple of amateur up bars into 160, 62, and just gone the other way. And so we've not seen exhaustion selling on the downside here. Exhaustion buying, and that's as good as we were able to do. We put in flush patterns here and here at these points here, and then another exhaustion buying signal here. So everybody's kind of got out of their positions, and we're going to be traveling down until we see some kind of exhaustion selling signal, certainly on the daily chart there. And Swiss franc on a monthly chart, so that was that kind of spike. On the weekly chart, there it is, exhaustion buy and blue professional bars. We've come back to a pullback in a downtrend kind of level, but it's extremely weak. And if you go down to the daily chart, we're drifting through support here, having had that kind of spike up there over 140. Flush signals, and we're kind of down here, and again this down move isn't over until we see similar kind of exhaustion selling on the downside. So there we go. That's kind of the big picture on the currencies. I mean, I think if you just think of the currencies in kind of two buckets, the risk on and risk off, and kind of the yen kind of is a bit of an enigma to me. But when you start looking at all the currencies kind of in concert, kind of the longer term moves, and you can use the better indicators or kind of commitment of traders type numbers. I think in bigger picture stuff, you can start to see the whole thing kind of rolling over. So where's this going to go? I mean, on this chart, I would think the next place up is where these start to converge. When we start to see these currencies kind of, where the dollar index kind of comes back up, and these kind of risk-on currencies kind of come back, maybe around parity. But we could be talking about a fairly, I mean, this move took a year to get going. So if we're talking about kind of almost double that type of move, so this could be fairly seminal in terms of this change. And then at some point, people are going to turn their attention to the US deficit and US treasuries and say that they're kind of unsustainable, and in the long term that is the case, but in the short to medium terms, like all eyes are on Italy, Spain, the pig nations in Europe, and what the ECB is going to do. So and that will all, I think, favour the US dollar and US treasuries in the meantime. Anyway, there we go. Quite a long video, but just talking about some thoughts on FX, and hope you're enjoying your long weekend.